Hi, everyone, and welcome again to our weekly 20-minute webinar. It's obviously a day early, ahead of a long and dare I say, well-deserved weekend, holiday weekend after what's been a pretty tumultuous 2 to 3 months in financial markets. So I'm Jim McCormick, head of desk strategy at NatWest Markets. Joining me again today are co-head of global economics, Michelle Girard and Ross Walker. We also have Giovanni Zanni, our chief Euro area economist. Today's agenda, Ross will start with an update on the UK political situation. Giovanni will follow with a preview of tonight's Eurogroup meeting, or should I say the second Eurogroup meeting after the first one failed earlier this week. Michelle will discuss US labor market dynamics and the progress on some of the fiscal buffers in the US. And once again, I will finish up with a quick discussion of markets and some market themes. We will have Q&A afterwards. You can send any text questions to us during the session, or you can use the raise hand function on Zoom during the actual Q&A. So with that, I'll hand it over to Ross.
Thanks, Jim. The main theme in the UK this week has been a sense of rising political risk. The Prime Minister's admission to intensive care being the main trigger. We think a lot of this discussion is really overdone. So firstly, that there is very, very little prospect, almost none at all, of a general election. The Fixed Term Parliaments Act remains in place. That presents a significant hurdle. Clearly, the disruption around COVID-19 makes any early election an impossibility to hold. And the fact that there was an election at the very end there's very little prospect of any political disruption. For that. So in terms of the other issue that has arisen is the Brexit process, and we've had various questions. For example, could Brexit be stopped? Well, no, primarily because it's already happened, and for the UK to reverse the Brexit decision would involve a lengthy reapplication process and so on. So that is clearly not a runner. The Brexit process negotiation on the trade deal has clearly slowed, given that both Michel Barnier and David Frost, the two lead negotiators, have been self-isolating. So the possibility of higher level political decisions being made in terms of the trade negotiation is probably impeded. But at a technical, official level, discussions go on. There have been various exchanges of position papers, draft legal texts, and so on. And we head for the next joint committee, UK-EU committee meeting in June. And that is just ahead of the point where the key immediate issue, whether there is an extension of the transition period. We think the probability of an extension is rising. We would maybe put that at around 45%. If something as serious and disruptive as COVID-19 can't get you some sort of extension, it's hard to imagine what would. Equally, the risk of no deal, a move to WTO at the beginning of next year is probably also edging up, simply because that is the default option and something needs to happen to prevent that. So overall, some heightened risk around Brexit, but on balance, we think probably an extension will come. That doesn't necessarily mean that the end point in terms of the trade deal will be materially softer or less disruptive, but a little bit of extra time maybe lessens some of the risks. So overall, a fairly quiet week. Data-wise in the UK, our forecasts are for a very sharp fall in the economy in Q2, a 13% drop in the quarter, growth down 6.5% this year as a whole. And the week after the return from Easter, we'll start to get some key data against which we can benchmark those forecasts.
Group meeting. Thanks, Ross. We're going to head over to Giovanni to preview the Eurogroup meeting.
Yes, hi everyone. Well, the real game changer was really the ECB with the PEP instrument, not only because of its size, but also because of its flexibility and frankly, scalability. And what we had yesterday was an interview from Lagarde, and she was basically adding another layer of dovishness, suggesting that, of course, that tool could be increased and extended in time, and that there could be also other instruments in the pocket of the ECB. There was also a change in the collateral rules of the ECB earlier this week. And again, this is basically something that is supporting even further the economy through the central bank, and is also providing support for the fiscal action of governments. So, but of course, I mean, the Eurogroup is relevant because the ECB cannot act permanently in a political void. So the Eurogroup this week is important for essentially the validation and continuation of the ECB action that we have seen and that has been put in place. So what at stake really in this Eurogroup meeting? Well, there are two things. First, there is a package of measures worth roughly 500 billion that involves the existing institution of Europe. So there's a program from the European Commission for workers, 100 billion, it's called SURE. There is another one that will increase the firepower of the European Investment Bank, 200 billion. And then there is the possibility of getting access of ESM funds for up to 2% of GDP. So that would be another 250 billion. Do we need this package? Well, in a strict sense, we don't, because the mix of relaxation coming from the European Commission already in terms of fiscal rules at the national level, and also the ECB buying bonds means that government can spend their way out of this crisis, especially for the emergency phase. But as I said before, there's a need for a political validation, and especially for the phase 2, for the recovery phase after the emergency. And that's really the second part of the discussion that we want to see, that we are waiting from the Eurogroup. We should agree, I think, at least on a kind of capacity of fiscal capacity, joint fiscal capacity, mutualization, at least in principle, for this recovery phase. And interestingly, if you look at the normal split in Europe, not just in the Eurogroup, it was between Italy on one side and Germany on the other, with France playing a little bit the role of putting the two together. Well, in this phase, things have changed. I mean, goalposts are being moved, and we see Italy with Spain and a lot of other countries and France clearly on one side, with Germany probably going in that direction as well. And on the other side, you have basically the Netherlands with a few other smaller satellite countries like Austria and Finland that are sticking to the no mutualization line of previous time. So we'll see what happens tonight. I mean, it's possible that we don't get a conclusion. It's possible that it's too early to find an agreement, and that we will have to move not just at the Eurogroup level, but at the higher EU Council level of heads of state. Having said that, it must be clear that there are ways to get around of a veto from the Netherlands. It happened before. The ESM initially, there was the veto, for example, from the UK, so it was created outside the treaty. When the ESM was created, Finland created problems inside, and so there were new rules for emergency that reduced the threshold, below unanimity. So if there is a will, as Merkel normally says, there is a way, and especially if Germany is part of this group of countries that want to go ahead. So just to conclude, the meeting is relevant for the political cap to the ECB action, as I was mentioning before. It doesn't have to happen tonight, but of course, it has to happen at some point, because otherwise there's a bigger risk for the Union. So that's the big challenge is there. So it's not that the euro ends tonight if there's no deal, but Europe needs to advance on this front and on others.
Thanks, Giovanni.
And
over to Michelle to talk about the the U.S. labor market dynamics and the success or failure of the fiscal buffer so far.
Thanks, Jim. Yeah, I did want to just spend a few minutes today talking about the unemployment situation in the U.S. because, as we've discussed, clearly the speed and the strength of the rebound that we can expect in any economy, will depend in large part on the extent to which we see jobs that are lost, the magnitude of the income hole that's created by lost work. There was an FT Peterson Institute poll out that showed in the US, the bulk, like roughly 3/4 of respondents felt that they had their family income had taken a hit as a result of COVID-19. And interestingly, it was the same whether you looked at those earning less than $50,000 a year or those looking over $100,000 a year. In both cases, 71 to 74% felt that family income was going to be down as a result or had been impacted adversely because of COVID-19. Now, clearly we saw in the March employment statistics last week, which captured more of the impact from COVID-19 than we had expected to see because of the timing of the survey. In any case, the unemployment rate already has jumped from 3.5% to just shy of 4.5%. And the BLS actually indicated that they think there was some classification issues for workers that indicated they were still employed but weren't at work that probably should have been listed as unemployed. And in that case, the unemployment rate may have already be, just shy of 5.5%. The one thing I wanted to point out, if there was any silver lining to the statistics that we saw for March, was that of the 1.4 million people who were classified or were reported to be unemployed that led to that jump in the unemployment rate, over 1 million of them, so the bulk of them, were individuals who said that they were unemployed and on temporary layoff. And to be classified in that way, it means that they indicated that they expected to be returned to work within 6 months' time. And so that's, to the extent, again, that there's some hope here that, as staggering as the job losses are, they may be quickly absorbed. That's a positive. And certainly the government is doing what it can to ensure that either workers are kept on or that they are rehired quickly. Importantly, we're watching the progress of one part of the $2 trillion fiscal stimulus plan, the Paycheck Protection Program, which offers businesses loans to continue to meet payroll, and that loan becomes a grant. They don't have to repay the loan if they maintain payroll levels or, importantly, rehire any of the workers that have been laid off by June 30th. So far, in just a week's time, there have been over 380,000 loans that have been approved, totaling $100 billion. And of course, we're seeing action already out of Washington to increase from $350 billion to perhaps close to $600 billion, the amount of funding for that program. So good news and something to be watching on that front. The other thing I wanted to talk briefly about was to make mention of the one of the fiscal buffers directly related to consumers. And of course, consumers are as part of that $2 trillion CARES package are getting $1,200 checks. But on top of that, unemployment benefits have been increased pretty dramatically. The benefits, first of all, have been expanded. They now include self-employed individuals working in the gig economy. That's a new expanded development. In addition to the fact that they're unemployed are eligible for benefits for now 13 weeks, it's also the case that individuals are getting an extra $600 per week on top of their state employment benefits. So in total, workers are getting nearly $1,000 per week. I should say workers, unemployed individuals are getting $1,000 per week as in their unemployment benefits. And importantly, this is more than what in some cases workers were earning while they were on the job, particularly in sectors that have been very hard hit. In leisure and hospitality, for example, average weekly earnings are about $460 per week. So when you think about the amount being earned or received from unemployment benefits, it's nearly double that. And that's the case as well in other sectors, such as the retail sector and other services. So there is some perhaps good news here on the front of there is some cushion in terms of helping to buffer consumers from the impact of COVID-19. And of course, these are developments that we'll be watching very closely, because it does speak very directly to how quickly we can see a bounce back in activity, and in particular in consumer demand once the restrictions are lifted. And with that, let me turn it back over to Jim.
Well, thanks, Michelle. I'm going to switch over to markets now, and just personally looking back on the week, it's actually been a pretty good week for markets, at least so far. The bounce has been led by U.S. high yield credit, but we've had a very good week for global equities, and even emerging markets have been a little bit more stable in the past couple of days. I thought it was quite notable, for instance, that South African local bonds were one of the best performers in our macro radar, despite the fact that we've had 2 ratings downgrades in just the past 2 Fridays. This positive tone in markets is happening, certainly, we think, pretty much for the reasons that we cited on this call last week. Namely, we did have a better week in terms of news flow around the virus data. And there, I think there's 3 general stories that I think are important here. Firstly, we are seeing peaks in daily mortality rates in continental Europe, as we did suggest last week. Importantly, we're not seeing the major surge in infection trends in some of the large, more vulnerable emerging market economies like India and Brazil, for instance. And I think also similar to that, so far, and it's still very early days, but we're not seeing a surge in infection trends in some of the states in the United States outside of the New York area. And I think, interestingly and quite importantly, this is the first week where you've started to hear a lot of countries in Europe discussing exit plans in terms of the lockdown restrictions. We had very specific discussions in Austria, Norway, and Switzerland, and even a few general discussions in both Germany and Italy. Next week, the big focus on the virus data will be the UK and the US, New York in particular. In the UK, we do expect the daily mortality numbers to peak early in the week, and for the New York area, probably late next week, if not then, probably early in the following week. What I would say is I do worry a little bit that the positive sentiment may have swung too far here. S&P 500 is now 25% above the low intraday on March 23rd, and it's only 20% below the peak we had in mid-February. And this type of decline, so a 20% decline, would not even be consistent with a mild recession, never mind the size of the recession that Michelle, Ross, and Giovanni are penciling in for some of the world's biggest economies. Net, I think relative to last week, I'd be a little bit more cautious on risk assets here. In terms of market themes, I want to talk about one longer-term theme and one shorter-term theme. Longer term, we did speak last week a little bit about the complacency in global rates. Namely, the view really was that despite the surge in government's bond supply, we need not worry in terms of rates markets, because central banks were gonna buy it all up. And I was very skeptical of that view last week, and this week we did start to see a little bit of underperformance creeping into core rates markets. Key point here is that the central bank bond buying, which has been so enormous in the past few weeks, is starting to slow, or will start to slow relatively soon. And against this, the government bond supply is starting to pick up. And I would look to agile markets, because this week we published detailed government supply forecasts for both the Eurozone and the US. Suffice to say, those numbers for gross issuance this year are going to be enormous. Our own view, as we said last week on rates markets, is that the surge in fiscal deficits will mean, all else equal, higher bond yields, steeper curves, higher break-even inflation. And though it's still very early days, for anyone who is bullish on core bond markets right now, I'll leave you with two observations. So first observation is, given the size of the central bank bond buying, enormous bond buying the past 3 to 4 weeks, I'd be a little bit worried that the bond yields aren't even lower. In fact, German bond yields are higher than they were 3 to 4 weeks ago. And second point I'd make is I'll note the rising correlation between equity and fixed income returns. This is a very complicated topic, so I'm not going to spend very much time on it, but suffice to say, in the past 10 years, the only time that you've had a significant rise in the correlation between fixed income returns and equity returns is normally when central banks are tightening policy. The fact that we're getting an increase in that correlation at a time of acute risk aversion and massive central bank policy easing should be a very big worry to bond bulls. So short term, let me finish with oil, given that we have the OPEC meeting later today and the broader G20 meeting tomorrow. Our base case is that we do get a supply cut, agreed supply cut of somewhere around 10 million barrels per day, agreed over the course of the next 2 days. But I will strongly emphasize that firstly, the risks are pretty finely balanced, and I think that a deal is a necessary condition to just keep prices stable. I don't really see much upside in oil prices from here. And why are the risks so high? Well, firstly, the deal that is on the table, you should recognize, is unprecedented. This isn't an OPEC only supply cut. It will be OPEC plus most of the other major oil producers in the world, the U.S. In particular. This is a very complicated deal to pull off. And obviously the goodwill among some of the major players is not at particularly high levels, given the breakdown in talks last month. So lots at stake in terms of oil and markets over the next couple of days. What would the market implications be? Well, I will say that firstly, stable oil is really important here as a further stabilizer for general markets. It's been good. I think it's been part of the better performance in risk assets. And more specifically, if talks do fail, the U.S. high yield credit rally that we've seen in recent weeks will clearly be at risk, given how much weight energy has in that index. And in terms of a couple of our recommendations, break-even inflation, which were long, and Norwegian crown, which were long, would both probably suffer somewhat. So a really important couple of 2 days when it comes to the oil price. With that, I'm going to hand it over back to you to see if there are any questions.
So as a reminder, if you'd like to ask a question today, please use the raise hand function found on your device, or type your question using the Q&A function. We're going to hand back to Jim just while I wait for some questions to come in. Jim, over to you.
Yeah, so I do have a couple of questions already. So first is for Michelle. We didn't really cover U.S. politics much in the last two calls. How does this coronavirus impact the election dynamic?
Thanks, Jim. Yeah, that question, is one that we battle back and forth a bit with ourselves in terms of, on net, does this raise or lower the odds of a Trump reelection? Honestly, we see arguments on both sides. Clearly, the economy is going to suffer a deep recession, and on the November election date, we're going to be looking at an unemployment rate, even if we see a lot of workers rehired, that is elevated versus what it was pre-virus. And so, to the extent that Trump had economic and financial market, stock market tailwinds going into the election, that obviously has disappeared. Although I maintain that the president isn't going to get blamed for a COVID-19 induced recession. And in fact, what matters is his handling of the crisis, which approval ratings suggest, as they've risen, that Americans tend to be supportive, although it is split by party lines. I think there are two things that, as I said, sort of conflict here in terms of who comes out better. I mean, on one hand, the president is obviously very much in the spotlight. It's very difficult for Biden, who actually now with Bernie Sanders dropping out can certainly is absolutely assured to secure the Democratic nomination. He can't really gain any momentum. The focus is on the president and on the governors and on the virus, and there is no campaigning, so that clearly hurts his momentum. On the other hand, it does refocus attention on healthcare and even calls potentially for universal healthcare. And so to the extent that you have that becoming much more of a dominant issue, that could hurt Trump and the Republicans in November. So in fact, I think that you can argue on both sides of this, whether or not it has meaningfully altered the outlook. In the end, I think it is still going to be very closely debated going into November in terms of whether or not the president is reelected. I would only add that perhaps it has raised at times more question in market participants' mind who all along have sort of felt that the odds of a Trump reelection were relatively high. And in those minds, it may be more balanced.
Thanks, Michelle. Well, we do have a question, a new question, whether or not the dynamics that we're seeing are going to create higher currency volatility. And let me just, I guess, say a couple of general statements on volatility. I guess when we went neutral on risk assets a few weeks ago, the implication was that we would probably see at least a short period of lower volatility, obviously coming from ridiculously high levels. And I guess what we felt most strongly about was a lower rates volatility environment because of this balance between lots of central bank buying alongside not much government bond supply. I do think maybe we've got another week or two of quieter markets, but ultimately we still have a lot of uncertainty, particularly around growth in the global economy. And typically in that type of environment, what I've seen historically is a higher currency volatility environment. So I'd be a little bit skeptical about further significant declines in currency volatility here. And I would certainly be looking, given the environment that we're in, to perhaps find places to start buying again. Let me ask a question to Ross, since we're on the issue of currency. So sterling US dollar, sterling euro at some fairly interesting levels at the moment. Do these politics, the risks, hurt the rally in sterling, or is it something that we're supposed to keep going with?
Well, our FX strategy team, led by Paul Robson, have been doing a lot of work on this lately and have been arguing that sterling valuations have looked very stretched relative to underlying fundamentals. We often see this in crisis situations. Sterling does seem to suffer to be sold off disproportionately. I think certainly the last week and this sense of heightened political risk added to that, but it feels like we have some upside potential here, we think. So in terms of sterling euro, obviously a key currency pair for the UK corporate sector, Paul and his team are sort of looking for a rise of 2, maybe up to 3 cents. So to €1.17, €1.18 type territory. We can see also some perhaps more modest gains, but some gains, ongoing gains for the pound against the dollar, maybe 126, 127, those sort of levels. So it feels on a fundamentals basis like sterling has been a little bit oversold. And although there are some key risk points in the road ahead, obviously the Brexit process we've discussed, for now, I think there is some upside momentum, and the next week or so will be an interesting test of that.
Thanks, Ross. I've got one last question for Giovanni. Market space question here. Is success of this Eurogroup meeting urgently necessary for European markets, or is it a nice to have, in the sense that is the QE that you're getting from the ECB enough for now?
Well, certainly, and as we've seen already with the first attempt to get to a final conclusion earlier this week, that there has been some market volatility effects on the day, but it was, I mean, quickly resolved just because, you know, as you're implicitly saying, I mean, the ECB is there, and yesterday's interview from Lagarde and the measure that were also added to the ECB toolbox through all these collateral new rules add further to that. So I would say it's a nice to have for tonight, but it's a necessary condition in, let's say, in a just slightly longer term. So we cannot escape the political support forever.
Great, thanks, Giovanni. Well, I don't think we have any more questions. And so with that, we'll say goodbye for the week. Again, we wish you all a good long holiday weekend, and hope to sort of see you here next Friday when we do our next call. Thanks again.